Hello, everyone. Welcome back to Premier Study and Investing. Today, I'm going to be reading an article pushed out by Jeremy Grantham. He's with GMO. They are a 40-year-old investment firm, and you'll learn a little bit about him. He basically talks about the bull market that we've been in and some of his ideas about the coming downturn, essentially. Spoiler alert. But, for those of us who are interested in what 2021 has to hold as far as equities, maybe we've seen different things come out from Kathy Woods, from ARK Invest, or other people who are just, looking at, well, maybe Northman Trader is interesting as well. So, a lot of people. Let's see what Jeremy has to say in his executive summary, which I will post in the descriptions below. So he starts, the long bull market, since 2009, has finally matured into a full-fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and hysterically speculative investor behavior. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea Bubble, 1929, and 2000. These great bubbles are where fortunes are made and lost, and where investors truly prove their mettle. For positioning a portfolio to avoid the worst pain of a major bubble breaking is likely the most difficult part. Every career incentive in the industry and every fault of individual human psychology will work towards sucking investors in. But this bubble will burst in due time, no matter how hard the Fed tries to support it, with consequent damaging effects on the economy and on portfolios. Make no mistake, for the majority of investors today, this could very well be the most important event of your investing lives. Speaking as an old student and historian of markets, it is intellectually exciting and terrifying at the same time. It is a privilege to ride through a market like this one more time. Most of the time, perhaps 3/4 of the time, major asset classes are reasonably priced relative to one another. The correct response is to make modest bets on those assets that measure as being cheaper and hope that the measurements are correct. With reasonable skill at evaluating assets, the valuation-based allocator can expect to survive these phases intact with some small outperformance. Small, which he puts in quotes, because the opportunities themselves are small. If you wanted to be unfriendly, you could say that the asset allocation in this phase is unlikely to be very important. It would certainly help in these periods if the manager could also add value in the implementation from the effective selection of countries, sectors, industries, and individual securities, as well as major asset classes. The real trouble with asset allocation, though, is in the remaining times when the asset prices move far away from fair value. This is not so bad in bear markets because important bear markets tend to be short and brutal. The initial response of clients is usually to be shocked into inaction. During the phase, the manager has time to reposition both portfolio and arguments to retain the business. The real problem is in major bull markets that last for years. Long, slow-burning bull markets can spend many years above fair value, and even 2, 3, or 4 years above fair value. These events can easily outlast the patience of most clients. And when price rises are very rapid, typically toward the end of a bull market, impatience is followed by anxiety and envy. As I like to say, there is nothing more supremely irritating than watching your neighbors get rich. How are clients to tell the difference between extreme market behavior and a manager who has lost his way? The usual evidence of talent is past success, but the long cycles of the market are few and far between. Winning 2 out of 2 events, or 3 of 3, is not as convincing as a larger sample size would be. Even worse, the earlier major market breaks are already long gone. 2008, 2000, 1989 in Japan are practically in the history books. Most of the players will have changed. Certainly the satisfaction felt by others who eventually won long ago is no solace for current pain experienced by you personally. The simpler way of saying this may be that if Keynes really had said, the market can stay irrational longer than the investor can stay insolvent, he would have been right. I am long retired from the job of portfolio management, but I'm happy to give my opinion here. It is highly probable that we are in a major bubble event in the US market, of the type we typically have every several decades, and last had in the late 1990s. It will very probably end badly, although nothing is certain. I will also tell you my definition of success for a bear market call. It is simply that sooner or later there will come a time when an investor is pleased to have been out of the market. That is to say, he will have saved money by being out and also have reduced risk or volatility on the round trip. This definition of success absolutely does not include precise timing. Predicting when a bubble breaks is not about valuation. All prior bubble markets have been extremely overvalued, as is this one. Overvaluation is a necessary but not sufficient condition for their bursting. Calling the week, month, or quarter of the top is all but impossible. I came fairly close to calling one bull market peak in 2008 and nailed a bear market low in early 2009 when I wrote Reinvesting When Terrified. That's far more luck than I could hope for even over a 50-year career. Far more typically, I was 3 years too early in the Japan bubble. We at GMO got entirely out of Japan in 1987 when it was over 40% of the EAFE benchmark and selling at over 40 times earnings against a previous all-time high of 25 times. It seemed prudent to exit at that time, but for 3 years, we underperformed painfully as the Japanese market went to 65 times earnings on its way to becoming over 60% of the benchmark. But we also stayed completely out for 3 years after the top and ultimately made good money on the round trip. Similarly, in 1997, as the S&P 500 passed its previous 1929 peak of 21 times earnings, we rapidly sold down our discretionary U.S. equity positions, then watched in horror as the market went to 35 times on rising earnings. We lost half our asset allocation book of business, but in the ensuing decline, we much more than made up our losses. Believe me, I know these are old stories, but they are directly relevant. For this current market event is indeed the same old story. This summer I said it was likely that we were in the later stages of a bubble, with some doubt created by the unique features of the health crash. The single most dependable feature of the late stages of the great bubbles of history has been really crazy investor behavior, especially on the part of individuals. For the first 10 years of this bull market, which is the longest in history, we lacked such wild speculation. But now we have it in record amounts. My colleagues Ben Inker and John Pays have written about some of these examples of mania in their most recent GMO quarterly letter, including Hertz, Kodak, Nikola, and especially Tesla. As a Model 3 owner, my personal favorite Tesla tidbit is that its market cap, now over $600 billion, amounts to over $1.25 million per car sold each year versus $9,000 per car for General Motors. What has 1929 got to equal that? Any of these tidbits could perhaps be dismissed as isolated cases. Trust me, they are not. But big picture metrics look even worse. The quote-unquote Buffett indicator, total stock market capitalization to GDP, broke through its all-time high 2000 record. In 2020, there were 480 initial public offerings, including an incredible 248 SPACs. More new listings than the 406 IPOs in 2000. There are 150 non-microcap companies, that is, with market capitalization of over 250 million, that have more than tripled in the year, which is over 3 times as many as any year in the previous decade. The volume of small retail purchases of less than 10 contracts of call options on U.S. equities has increased 8-fold compared to 2019, and 2019 was already well above long-run average. Perhaps most troubling of all, Nobel laureate and longtime bear Robert Shiller, who correctly and bravely called the 2000 and 2007 bubbles, and who was one of the very few economists I respect, is hedging his bets this time, recently making the point that his legendary CAPE asset pricing indicator, which suggests stocks are nearly as overpriced as the 2000 bubble peak, shows less impressive overvaluation when compared to bonds. Bonds, however, are even more spectacularly expensive by historical comparison than stocks. Oh my. So, I am not at all surprised that since the summer, the market has advanced at an accelerating rate and with increasing speculative excesses. It is precisely what you would expect from a late-stage bubble, an accelerating, nearly vertical stage of unknowable length, but typically short. Even if it is short, the stage at the end of a bubble is shockingly painful and full of career risks for bears. I'm doubling down because as prices move further away from trend at accelerating speed and with growing speculative fervor, of course my confidence as a market historian increases that this is indeed the late stage of a bubble that is beginning to look like a real humdinger. The strangest feature of this bull market is how, unlike every previous great bubble, it is in one respect. Previous bubbles have combined accommodative monetary conditions with economic conditions that are perceived at the time, rightly or wrongly, as near perfect, which perfection is extrapolated into the indefinite future. The state of economic excellence of any previous bubble, of course, did not last long. But if it could have lasted, then the market would have justifiably have sold at a huge multiple a book. But today's wounded economy is totally different. Only partly recovered, possibly facing a double dip, probably facing a slowdown, and certainly facing a high degree of uncertainty. Yet the market is much higher today than it was last fall when the economy looked fine and unemployment was at a historic low. Today, the PE ratio of the market is in the top few percent of the historical range, and the economy is in the worst few percent. This is completely without precedent, and may even be a better measure of speculative intensity than any SPAC. This time, more than in any previous bubble, investors are relying on accommodative monetary conditions and zero real rates extrapolated indefinitely. This has, in theory, a similar effect to assuming peak economic performance forever. It can be used to justify much lower yields on all assets and therefore correspondingly higher asset prices. But neither perfect economic conditions nor perfect financial conditions can last forever. And there's the rub. All bubbles end with near universal acceptance that the current one will not end yet because in 1929 the economy had clicked into, quote, a permanent high plateau, end quote, because Greenspan's Fed in 2000 was predicting an enduring improvement in productivity and was pledging its loyalty, or moral hazard, to the stock market. Because Bernanke believed in 2006 that, quote, U.S. house prices merely reflect a strong U.S. economy, end quote, as he perpetuated the moral hazard. If you win, you're on your own. But if you lose, you can count on our support. Yellen, and now Powell, maintain this approach. All three of Powell's predecessors claimed that the asset prices they helped inflate, in turn, aided the economy through the wealth effect, which effect we all admit is real. But all three avoided claiming credit for the ensuing market breaks that inevitably followed. The equity bust of 2000 and the housing bust of 2008, each replete with the accompanying anti-wealth effect that came when we least needed it, exaggerating the already guaranteed weakness in the economy. This game surely is the ultimate deal with the devil. Now, once again, the high prices this time will hold because interest rates will be kept around nil forever in the ultimate statement of moral hazard. The asymmetrical market risk we have come to know and depend on. The mantra of late 2020 was that engineered low rates can prevent a decline in asset prices forever. But of course, it was a fallacy in 2000, and it is a fallacy now. In the end, moral hazard did not stop the tech bubble decline, with the Nasdaq falling 82%. Yes, 82%. Nor, in 2008, did it stop U.S. housing prices declining all the way back to trend and below, which in turn guaranteed, first, a shocking loss of over $8 trillion of perceived value in housing, second, an ensuing weakness in the economy, and third, a broad rise in the risk premia and a broad decline in global asset prices. All the promises were in the end worth nothing, except for one. The Fed did what it could to pick up the pieces and help the markets get back into stride for the next round of enhanced prices and ensuing decline. And here we are again, waiting for the last dance and eventually for the music to stop. Nothing in investing perfectly repeats, certainly not in investment bubbles. Each form of irrational exuberance is different. We are just looking for what you might call spiritual similarities. Even now, I know that this market can soar upwards for a few more weeks or even months. It feels like we could be anywhere between July 1999 and February 2020, which is to say, it is entitled to break any day, having checked all the boxes, but could keep roaring upward for a few months longer. My best guess as to the longest this bubble might survive is the late spring or early summer, coinciding with the broad rollout of the Rona vaccines. At the moment, the most pressing issue facing the world economy will have been solved. Market participants will breathe a great sigh of relief, look around, and immediately realize that the economy is still in poor shape. Stimulus will shortly be cut back with the end of the health crisis, and valuations are absurd. Quote, buy the rumor, sell the news. But remember that timing the bursting of bubbles has a long history of disappointment. Even with hindsight, it is seldom easy to point to the pin that burst the bubble. The main reason for this lack of clarity is the great bull markets did not break when they were presented with a major unexpected negative. Those events, like the portfolio issuance fiasco of 1987, tend to give sharp down legs and quick recoveries. They are, in the large scheme of things, unique and technical and are not part of the ebb and flow of great bubbles. The great bull markets typically turn down when the market conditions are very favorable, just subtly less favorable than they were yesterday, and that is why they are always missed. Either way, the market is now checking off all the touchy-feely characteristics of a major bubble. The most impressive feature are the intensity and enthusiasm of bulls, the breadth and coverage of stocks in the market, and, above all, the rising hostility toward bears. In 1929, to be a bear was to risk physical attack and guarantee character assassination. For us, 1999 was the only experience we have had of clients reacting as if we were deliberately and maliciously depriving them of gains. In comparison, 2008 was nothing. But in the last few months, the hostile tone has been rapidly ratcheting up. The irony for bears is that it's exactly what we want to hear. It's a classical precursor of the ultimate break, together with stocks rising, not for their fundamentals, but simply because they are rising. Another more measurable feature of late-stage bull, from the South Sea bubble to the tech bubble of 1999, has been an acceleration of the final leg, which in recent cases has been over 60% in the last 21 months to peak, a rate well over twice the normal rate of bull market ascents. This time, the U.S. indices have advanced from plus 69% for the S&P 500 to plus 100% for the Russell 2000 in just 9 months. Not bad. And there may still be more climbing to come, but it has already met this necessary test of a late-stage bubble. It is a privilege as a market historian to experience a major bubble once again. Japan in 1989, the 2000 tech bubble, the 2008 housing mortgage crisis, and now the current bubble. These are the 4 most significant and gripping investment events of my life. Most of the time, in more normal markets, you show up for work and you do your job, ho-hum. And then, once in a long while, the market spirals away from fair value and reality. Fortunes are made and lost in a hurry, and investment advisors have a rare chance to really justify their existence. But as usual, there is no free lunch. These opportunities to be useful come loaded with career risk. So, here we are again. I expect once again for my bubble call to meet my modest definition of success. At some future date, whenever that may be, it will have paid for you to have ducked from midsummer of 2020. But few professional or individual investors will have been able to abduct. The combination of timing uncertainty and rapidly accelerating regret on the part of clients means that the career and business risk of fighting the bubble is too great for the large commercial enterprises. They can never put their full weight behind bearish advice, even if the PE goes to 65 times as it did in Japan. The nearest any of these giant institutions have ever come to offering fully bearish advice in a bubble was UBS in 1999, whose position was nearly identical to ours at GMO. That is to say, somewhere between brave and foolhardy. Luckily for us, though, they changed their tack and converted to a fully invested growth stock recommendation at USB Brinson and its subsidiary Philip and Drew in February 2000, just before the market peak. This took out the 800-pound gorilla that would otherwise have taken most of the rewards for stubborn contrarians. So, don't wait for the Goldmans and the Morgan Stanleys to become bearish. It can never happen. For them, it is a horribly non-commercial bet. Perhaps it is for anyone. Profitable and risk-reducing for the clients? Yes. But commercially impractical for advisors. Their best policy is clear and simple. Always be extremely bullish. It is good for business and intellectually undemanding. It is appealing to most investors who prefer optimism to realistic appraisal, as witnessed so vividly with the health crisis of 2020. And when it all ends, you will, as a persistent bull, have overwhelming company. This is why you have always had bullish advice in a bubble and always will. However, for any manager willing to take on that career risk, or more likely for the individual investor, requiring that you get the timing right is overreach. If the hurdle for calling a bubble is set too high so that you must call the top precisely, you will never try. And that condemns you to ride over the cliff every cycle, along with the great majority of investors and managers. What to do? As often happens at bubbly peaks like 1929, 2000, and the Nifty 50 of 1972, a second-tier bubble in the company of champions, today's market features extreme disparities in value by asset class, sector, and company. Those at the very cheap end include traditional value stocks all over the world relative to growth stocks. Value stocks have had their worst ever relative decade ending December 2019, followed by the worst ever year in 2020, with spreads between growth and value performance averaging between 20 and 30 percentage points for the single year. Similarly, emerging market equities are at a one of their three, more or less co-equal relative lows against the US of the last 50 years. Not surprisingly, we believe it is in the overlap of these two ideas, value and emerging, that your business bets should go, along with the greatest avoidance of US growth stocks that your career and business risk will allow. Good luck. Okay, so just if you want to go back and read it on your own, no problem. A couple terms. PE is the price to earnings multiple. It's, if a company earns a dollar of earnings per share and it trades at $5 per share, then that would be a PE of 5. Price in the numerator, the earnings per share in the denominator. So like we see now, it's really high. I think they say that today the PE ratio of the market is in the top few percent of historical range, and the economy is in its worst few percent. Well, I thought that would be interesting to everybody. I hope you enjoyed. Thanks so much. Please share, like, subscribe. Be careful with your money out there. Definitely, I would ask you to think what you think is going to be the peak for the S&P 500. Today we're right around 3,800. Do you think it's going to go to 4,000? Do you think it's going to go to 4,200, 4,500? You're talking about somewhere between a 5 and a 10% gain between where we are and the peak, if you put it those numbers. If we relive March, generally the S&P 500 fell somewhere around 37%. So you need to think, are you willing to go after a 10% potential gain for a 37% hit? And don't forget to do the math. If you have $100 and you gain 10%, you're at $110, correct? Then if you go on to lose 37% on your $110, you're back at $69, a 31% loss. So you really need to be careful. I hope that's helpful to everyone. We'll talk to you guys next time.